All right, welcome everyone. Go ahead and take your seats, get comfortable. Today's explainer lecture is a big one, so I hope you're ready. We are diving deep into Chapter 7 of your Advanced Financial Accounting module. For this entire session, we're going to focus strictly on owner's equity and profit distribution. Basically, I'm going to walk you through exactly how we account for the absolute lifeblood of any business, its capital, and, just as importantly, how we divide up the rewards when that business actually succeeds. These rules, as you'll see, are the foundation of corporate transparency, so let's take this step by step.
Here is a quick look at our syllabus for today. We'll cover the legal framework, capital contributions, profit distribution, enterprise types, foreign exchange principles, and finally, FX accounting methods.
Section 1. Legal framework and equity. Let's get right into it.
Okay, so we're starting with the absolute bedrock of our practice, which is the legal framework that dictates how we recognize capital. You know, in accounting, we don't just make up the rules as we go along. We follow a very strict legal architecture. So, please take out your notebooks because this right here is a crucial exam point. The regulatory landscape has shifted recently. We are still guided by the Law on Accounting 2015 and the Enterprise Law 2020 for sure, but here's the big news. The new Circular 99/2025 has officially replaced the older Circulars 200 and 133. Now, why does this matter so much to us? Well, because this new circular completely updates how we ensure compliance and how we handle our 400-level equity accounts. Circular 99 is your new, strict rulebook, and it's exactly what we will be applying in class today.
Let's start by defining our core concept. Owner's equity, or vuntusaho in Vietnamese, is simply your total assets minus your total liabilities. It's the true net worth that actually belongs to the shareholders. Now, listen closely, because the crucial rule of measurement here is that we always record equity at the actual contributed value, not just what was promised in the company charter. Promises simply don't balance the books. Actual tangible capital does. Furthermore, if an investor contributes non-monetary assets, say a piece of machinery or real estate, we strictly use the agreed fair value at the exact time of contribution, no exceptions.
To put this into practice, I want you to imagine a T account for the owner's investment capital, which is account 411. Got it in your head? Okay, on the debit side, we record decreases. Now you might be wondering, why is a return of capital a debit? Because it physically reduces the company's ultimate liability to its owners. This happens when we return capital or when we cancel treasury shares. Conversely, the credit side tracks our increases. This is where we record those initial cash contributions, new share issuances, and capital surpluses. A credit balance here always reflects the current total invested capital of the business.
All right, let's apply this theory with a quick in-class exercise. Consider a company named HDT. They are issuing shares in two very different market conditions. First, they issue shares above their par value, which creates a premium. But later on, the market drops, and they have to issue shares below par value, creating a discount. So how exactly do we capture this financial reality in our ledgers?
Let's look at the math step by step. In the first issuance, HDT sells 200,000 shares at 18,000 VND each. Now, that's well above the 10,000 VND par value, right? This creates a massive 1.6 billion VND surplus. So we debit cash, account 112, for the total received, 3.6 billion. We credit the share capital account 4111 for the 2.0 billion par value. And finally, we credit that surplus to the capital surplus account 4112 for 1.6 billion. But now consider the second issuance. They sell at 8,500 VND, creating a 1,500 VND discount per share. To balance this accurately, we debit cash, account 112, for the 425 million we actually got. But we have a shortfall, right? So we are forced to debit that same capital surplus account 4112 by 75 million VND to cover it, before finally crediting the share capital account 4111 for the 500 million par value. As you can see, the capital surplus account essentially absorbs the shocks of the market.
Let's move to our second case study. Here, member A brings in machinery instead of cash. Now, as accountants, we must completely ignore the old net book value that the contributor had, honestly, no matter how much they claim it's worth. We strictly use the Valuation Council's fair value, which is 850 million VND. We record the asset's gross historical cost to tangible fixed assets, account 211, at 1.2 billion, and the accumulated depreciation to account 214 at 300 million. Why? To perfectly match that 850 million fair value. But here's the catch. Member A was only allocated 800 million in charter capital in account 4111, so that remaining 50 million VND of fair value doesn't just vanish into thin air. It mathematically creates a capital surplus, which we credit directly to account 4112.
Section 3. Profit Distribution Process.
Now that we know how to strictly record the money and assets coming into the firm, let's figure out how to actually distribute the profit we've made. For retained earnings, which is account 421, the fundamental logic remains exactly the same. Credit is good news. It represents an increase from our post-tax profit generated during the period. The debit side, on the other hand, reflects the pie being sliced up. Whenever we pay out cash dividends, cover prior losses, or allocate money into specific corporate funds, we debit account 421, physically reducing our retained earnings.
I really want you to memorize this 5-step process for distributing profit. Seriously, this is not a suggestion. It is a legally required sequence. You can't just jump straight to paying out dividends to your buddies. First, you legally determine the net post-tax profit. Second, you must legally cover any of last year's carry-forward losses. Third, you strictly fund your mandatory financial reserves as required by corporate law and your own charter. Fourth, you fund voluntary internal funds like employee welfare or bonus funds. And only then, at step 5, are you permitted to pay out dividends to shareholders with the remaining balance. Let's crunch the numbers for case study 3 so you can see this strict legal order in action. We start step 1 with a very healthy $4.8 billion in profit. Following our mandatory steps, we immediately subtract the $500 million prior loss. That leaves us with $4.3 billion. From that, we deduct 5% for the investment fund, which is $215 million. Then 10% for the welfare fund, taking out another $430 million. Next, we pay an 8% cash dividend based on a $20 billion charter capital that costs us $1.6 billion. So, after all legal obligations and shareholder payouts, we are left with exactly $2.055 billion as retained earnings to securely roll over into the next year.
Section 4. Equity by Enterprise Type.
Moving forward, you absolutely need to understand that accounting isn't just one size fits all. The rules of equity change drastically depending on the legal structure of the business you are managing or auditing. While joint stock companies deal with share premiums and dividends per share, limited liability companies deal strictly with simple contribution percentages, and there's no public issuance. State-owned enterprises have their own highly stringent government capital regulations. But what is truly groundbreaking right now is that the new Circular 99/2025 provides highly anticipated, highly specific guidance on how modern startups must handle complex funding mechanisms. Consider the Vietlearn startup case. They receive a $5 billion VND convertible note. Essentially, it's a loan that might eventually become equity. Now, if the conversion is completely uncertain, standard practice dictates the entire $5 billion is recorded purely as a liability in borrowings, account 341. Makes sense, right? But if the option to convert to equity has a real calculable value, Circular 99 says we must legally split this instrument. We recognize the debt portion at, say, $4.7 billion in account 341, and then we credit the remaining $300 million value of the conversion option directly into a brand new equity account, account 4113. It's a real game changer for startup accounting. As a preview for your homework tonight, you are going to need to apply everything we just covered. You'll take on a complex scenario for Min-Long JSC featuring machinery contributions, share issuances, and a very detailed profit distribution resolution. Your job will be to determine the exact end-of-year balances for the share capital account 4111, the capital surplus account 4112, and the retained earnings account 421. And listen, I expect precise mathematically balanced journal entries, okay?
Section 5. Foreign Exchange. Core Principles.
Now, class, let's pivot to the second half of today's lecture. Please pay close attention here, as this is often the most mathematically challenging topic for students: foreign exchange differences. A foreign exchange difference, or Chenglek-Tiza, is not an accounting error. It's not a mistake. It occurs simply because currency is volatile in the real world. The value fluctuates between the moment a transaction actually happens and the moment you report it or settle it in Vietnamese dong. Our job as accountants is to accurately capture the financial impact of that real-world fluctuation. These currency differences are going to strike your ledger at 3 specific times. First, during the actual daily transaction, such as buying imported goods on a random Tuesday. Second, at the end of the accounting period, when you are legally required to revalue your foreign currency bank accounts and debts to reflect their true year-end value. And third, when translating entire financial statements, like when a Vietnamese subsidiary reports its financials upward to a foreign parent company.
The golden rule here, and honestly, if you learn only one thing about foreign exchange today, please let it be this, is knowing exactly which exchange rate to use. The actual rate is based on your commercial bank's average transfer rate today. It reflects economic reality right now.
The book rate, however, looks backward. It uses the specific or weighted average rate that is already sitting on your books from past historical transactions.
Let's move to how this builds our actual application rules. In practice, you use the actual rate when recording new revenues, new expenses, or when receiving foreign cash. Basically, when you are booking entirely new economic value. But you must strictly use the book rate when you are paying money out of your accounts or settling old debts. Why? Well, you use the book rate to clear out the exact Vietnamese dong amount you originally recorded so your accounts balance perfectly. The mathematical difference between that actual rate and your book rate is exactly what creates your exchange gain or loss.
And that brings us right to the end of period reevaluation. When December 31st hits, we reevaluate our monetary items using the current actual rate. If the currency moved in our favor, say our foreign cash is suddenly worth more in dong, we credit that gain to financial income, account 515. Conversely, if our foreign debt just became much more expensive to pay off, well, that loss is debited as a financial expense in account 635.
Let's prove this with the Futing case study right now. We are importing $10,000 worth of goods. Today's actual rate is 25,100, so we debit our inventory, account 156, for 251 million VND. But the USD sitting in our bank account was recorded at a historical book rate of only 24,800, so we credit cash in bank, account 112, for exactly 248 million. Now notice, our debits and credits do not balance. That 300 VND difference per dollar mathematically forces us to book a 3 million VND exchange loss directly as a debit into financial expenses, account 635.
So, the absolutely crucial point here is that none of this is just arbitrary math. As we wrap up this explainer lecture, I want to leave you with this question to ponder for our next session. How does mastering these intricate rules under Circular 99, accurately splitting those convertible notes, diligently calculating fair values, and transparently recording exchange losses, how does that ensure the financial health of a company is utterly transparent to the public and highly protective of its investors? Think about it, because that is the true, real-world purpose of advanced financial accounting. Please review your notes, tackle the homework, and I will see you all next time. Class dismissed.